The first home I bought, I thought I was just getting taken to the rack in terms of price. I should have bought 10 of them. Those homes are selling for 3 or 4 times what I paid for that first home.
Are we headed for another 2008 collapse?
The worst decision I ever made in real estate is not getting in sooner.
Welcome to another segment of If Your Money Could Talk. I'm your host, Ben Driggs, longtime financial advisor and president of Navigate Financial. Thank you very much for joining us. Today we're going to be talking about mortgages, lending, credit, and the like. We appreciate your spending a few minutes with us. And today in the studio, we have Jim Barnett. Jim is a longtime real estate guru and mortgage lender. And I've known him for many years and really appreciate his expertise. Appreciate him coming into the studio today. So let's begin. Jim, why don't you introduce yourself? Welcome. Appreciate your joining us today.
Thank you. Happy to be here. As you introduced that topic, I thought, is there a Cliff Notes version of this we can provide to people? It doesn't sound like super exciting, so we'll try and make it exciting so it's relevant for people and they can use it, and it's not just a boring topic, because it certainly could be.
Yeah.
So I've been in the business for over 30 years, real estate broker and mortgage broker. I get a lot of job satisfaction of helping people financially, a little bit different than you do. You and I kind of work hand in hand, and but I do get job satisfaction in knowing at the end of the day I've helped people financially, either with their assets in terms of real estate or debts, getting rid of mortgages or getting better mortgages, financing, that kind of thing. So I love what I do. I've been doing it a long time, and I still enjoy my job. So but I appreciate being here. Hopefully we can enlighten some people.
Yeah. Well, even in the introduction, I was thinking we need to make sure that the nomenclature, like the wording that we're using to explain these things, is that everybody understands, because mortgage, lending, credit, debt, these all kind of get mixed up into one, right?
Yeah, absolutely.
So let me start and say one thing in your case that not everybody in your profession does both of these. So let me mention this first. On one hand, you're a realtor, right?
Correct. Yep.
So a realtor is someone who helps clients buy and sell property,
yes,
real
buy
estate.
And sell property, negotiate contracts, kind of the real estate
That's
side.
the real estate side.
Yep.
Then you wear a second hat, which is completely different, but obviously very related, and that is, what do you call yourself? A mortgage lender?
Broker.
Mortgage broker.
So
the lender would be the
person actually loans the money. I don't have you the money. I find people that do have the money and try and convince them to loan it to you.
Okay. So you're a mortgage broker. Correct. So you say, I'm a realtor and I'm a mortgage broker.
Yes.
And depending on, I guess, like right now, interest rates are high, and so that probably slows down maybe one of these sides, maybe the real estate side or something. So probably throughout your career, one side is busy while the other is slow. Or
it's worked out well. I mean, it has been when rates are around 7, a little under 7 right now, which sounds high, but when I first got in the business, rates were 8.5%, 9%. Mm-hmm. So it's all relative to what you've seen. In the 80s, they were 20%.
Yeah.
So 7% is high for what we've been used to at 2 and 3% range. And when rates go up like they've done, then it typically is a little slower, like the mortgage side slows down. People don't want to sell a home that has maybe a 2 or 3% interest rate to go buy a new house where they're going to get a 7% rate. So they will stay in that home that they're in. Even if they might want to move, they're going to stay. So consequently, inventory is low. We can go into that later. But really, it's kind of ebbed and flowed for me. I didn't intend to do that when I started 30 years ago, but the company I worked for they required all the loan officers. I was started in the mortgage business to get their real estate license. So I just did both, kind of worked out that way. I can't legally do both on the same transaction. So I have partners in both arenas if I need to bring into play. Mm-hmm. But sometimes I'll do, like right now, I've got more real estate going on than I do mortgage, and it does ebb and flow that way.
Yeah. Another thing I wanted to do before we jump in and talk about what's happening in today's environment and maybe some stories that you could share of what your clients are experiencing. I wanted to take a step back and make sure everybody understands the basic concepts of borrowing. So at the risk of being very, very elementary here, can you explain what is happening when you go borrow money in that transaction,
Sure.
in that arrangement? Because a lot of people are either unfamiliar or uncomfortable or just overwhelmed by the
Sure.
whole thing of
Absolutely.
like, oh, I don't want to go into debt, and it's a 4-letter word. But explain the mechanics of debt
Okay.
or taking out a loan.
Sure. I'm gonna back up just a little bit and say, so if you're selling your house, for example, and I offer to buy your house, you, for the most part, you don't care where the money's coming from. All you want is let's say you're selling your house for $500,000. All you care about is you get your 500 grand. You don't care if I'm getting it from mom and dad. You don't care if I have it buried in the backyard. You don't care if I'm getting it from a bank or a credit union or a mortgage broker. You don't care.
Yeah.
You just want your money. As long as you get your money, you don't care. Now, there's a few caveats to that, but for the most part, you get your 500 grand and you don't care where it comes from. From a buyer's perspective, most people have to get a mortgage or bank financing of some sort, meaning you go to a lender or someone like myself. So you could go to XYZ bank. You could go there or a credit union and apply for a loan. They have kind of a limited supply or a limited products you can get. Whereas a broker like myself, I have a myriad of products, and I can go to any of those banks and solicit them to get. So you have hundreds, if not thousands, of options for me to get financing. And when you do the financing, so once again, if I'm going to get a loan to buy your house, what a lender's going to look at is a lot of different things. I call them the big three. Kind of three main things they're going to look at for me and say, Jim, can you really pay this money back? Are you really going to be a good credit risk for us? The first one is income, and in the income includes how much you're paid, how you're paid, like overtime, commission, shift differential, all that can dictate whether you can get a loan or not. So income is number one. Credit, which is pretty self-explanatory, what your credit scores are, but can also take into account debts, car loans, student loans, that kind of thing, how much debt you might have in monthly payments. And the third thing is down payment, where your money's coming from to put down, and how much you have to put down. And typically the more you have to put down, the better. So those are kind of, in a nutshell, three main things a lender's going to look at. And I could talk to you for 5 minutes about those three things and be able to decipher pretty quickly how much you can qualify for, if you can qualify, and even write you a letter that says, yeah, Ben's qualified to buy it.
Is there one that the lenders favor more than the others? Income? So as a review, there's the income, there's the credit, meaning how much debt you have, who you owe money to, do you have a good credit score?
Credit scores is kind of the main
one. And then the last one is
down payment.
How much you're going to be bringing to the table, right, as a down payment.
Yeah.
Is there one, if you had to, or it's like, no, they're
really.
all
there. I mean, there used to be, if you're missing one of the three, you can maybe, I mean, they have what are, back in the day, in 2008, when we call it the mortgage blow up, or when the financial crisis hit, you could be missing all three. I could get you a loan, 100% financing, no job, no credit, no money, no problem. That was kind of the terms a lot of people used. I didn't do loans in that scenario, but they were an option. So if you're missing income, there are loans that you can go, what are called stated income loans, sort of. In what you can do is basically they'll go off of bank statements and say, okay, we're going to take all your deposits, add them up for 24 months and divide by 24, and we're going to use that as your income. So you can kind of get around income a little bit that way. The rates are higher, so you're going to pay for it. They know if you can't meet those three basic criteria that you have a problem, so they're going to, when I say them, that whoever's lending the money, they're going to charge you more money for it. Credit, once again, like 780 credit is really good. The lower you go, the harder it is to do it and the more expensive it can get. So if you go to like a 680 credit score, I can still do a loan, but it might be a little trickier. If you go down to 620, might still be able to do it, just a little trickier, and rate's going to be higher. Once you get in the 500s, it gets a lot more difficult to do. But I'm not saying it's impossible, but stars have to line up. Down payment, there are actually no money down deals. I'm not a big fan of no money down. I feel like people need to have some skin in the game. But there are, typically you need at least 3% down, 3 to 5% down, up to, if you put 20% down, it's a better deal for you. But there are no money down deals that you can do. But there's a lot of strings attached, a lot of this has to line up and that has to line up. There's a lot of things like that. So, but anyway, that kind of gives you an idea of the big three that you'd be looking at.
Yeah. So you need money. You go to the bank, and then they review your case, and they say, we will give you this much money, etc. Will you explain how that process might be different from a real estate transaction, which is now the term mortgage is a real estate, more of a home, like
correct. Mortgages don't even
loan.
Exist. Yeah, mortgage really doesn't exist. It's a deed of trust in Utah, but for whatever reason, the mortgage stuck.
But that's just a loan. The term like a loan related to real estate, right?
Yeah,
a home
correct.
or something.
Yeah.
Okay. So, but what is the difference, and how might that look differently if you were to buy a car or a boat or a student loan? Is the concept very different? You're ultimately asking someone to loan you money, a financial institution, and they're going to evaluate you based on a set of criteria, and they're going to say, we will or will not, or we'll give this much money under these conditions. Does it change much in the real estate space, in the mortgage space, as opposed to a car loan, say, or a student loan? Or?
I would say it's different for sure. Real estate's going to scrutinize much heavier on those three things I mentioned. Whereas a car loan, if you went to get a car loan today, they might do it just on credit.
Credit only.
Enough credit. They may not even look at income. Same thing with a credit card. It depends on the type of credit card you get, but those kind of loans are going to go, I would say, much. You asked a question a few minutes ago, which of the three is most important? And I would say in the consumer debt arena, cars, student loans, credit cards, the credit score is going to weigh much heavier than a down payment, because in most of those you may not even need a down payment. Like a credit card, there's no down payment. You're just going to, there's no collateral. They're just basing on your good name and your credit history. Yeah. So whereas in the mortgage, down payment's important. Income is important. I had my daughters, might have kids that are kind of the age of starting to get credit cards and that kind of thing. And I had a daughter apply for a credit card, and she didn't get it, which surprised me. And I think it was because of income. She had a job, kind of a part-time job. Credit was good, but I think the credit card company looked at it as though she doesn't have enough income to make the payments on what this card potentially could go to. And that's one thing from a mortgage perspective, a lender's really looking at is, can you make this payment? You know, you're making $5,000 a month, and your payment's going to be $3,000 a month. Do those numbers make sense? And the answer is no. There's kind of ratios that we go off of, but it kind of has to be a make sense thing. And credit cards, I think, they don't look. It's not as make sense. It's more of a if they feel like they can get their money back, or they can charge you a high enough interest rate. It's like, maybe you don't have income. Okay, the rate is going to be 10. We'll charge you 25% interest. And if they have to write it off, they write it off and factor it down the road. But so I do think there's a difference for sure in how lenders or those loaning the money might look at how they're going to, what the terms they're looking at, or what they might be looking at to determine whether you're a good credit risk or not.
Let me use this as an opportunity to pivot just a bit. I hadn't intended to talk about this, but you would know more than I. Let's talk about the credit score breakdown. Okay. Yeah. What are the components? Again, I don't want to deep dive. Sure. I think we're probably going to have a segment just on the credit score. Okay. But just in general, what are the points there? How does someone improve his or her credit score? Or what are some just definite do's and don'ts in that space? Because bad credit score is it's just going to
killer.
It's going to kill you. Well, you're not going to be able to get the credit card. You're not going to be able to get the car. You're certainly not going to be able to get the home. All these things, credit score is really fundamental. So let's talk about that for a minute.
I'm going to tell you a quick story about credit card use, and then I'll tell you quickly about kind of what goes into that score. By the way, I call it the secret sauce. So the credit scoring companies, they won't tell you how they calculate it because it's their secret sauce. Yeah. But I can tell you from experience, I know what affects the credit score and other things. So credit score, I had a client come in looking to buy a house and pull their credit, and it was down a little bit. It was a little lower than maybe what it should have been. And there was a collection. I won't mention the company. They had a collection with one of the companies. It was like $80. And they hadn't paid it, and they were in dispute with this company about this amount. And consequently, it hurt their credit. It had dropped scores enough to the point where their interest rate on this house was going to be a quarter to 3/8 worse than what it would have been had they had good credit. And they were proud of the fact that they had disputed this account, and that they were, they hadn't paid this company, and the company was wrong, which the company may have been wrong. But the reality is they didn't pay the company $80 that was in dispute, and consequently it was going to cost them hundreds of thousands of dollars more in a higher interest over the life of that loan because they didn't make an $80 payment. So something is, and I don't think the younger generation, when they're getting out of high school, even young college kids, even adults I run into, they don't understand the implications of something simple as a small credit card payment or even a car payment. You miss one payment, it's like, not a big deal. Well, it can cost you hundreds of thousands of dollars in interest and a higher mortgage loan over the years because of a simple mistake. And what I would have told that person in hindsight, had they come to me initially, I'd have said, just pay it, move on, save your credit. It's worth saving your credit for $80, even if it's the principal of the thing and you don't want to, you don't owe it to them. Anyway, pay it, move on, and don't, because it's not worth the cost. It's going to cost you long term. So quickly, credit score. The biggest factor is obviously payments. If you're late on your payments, if you owe me money and you're supposed to pay me on the 1st and you don't pay me, and I call you and say, Ben, where's my money? And you're like, well, I just don't have the money right now. Sorry. Well, you still owe me the money, and whatever your reasons are, your wife lost her job or kids are sick or whatever it is. The fact is you owe me the money. And if you don't pay me, then that hurts our relationship because we have a contract. And so anybody you owe money to, a car loan, credit card, house, anything, if a payment is due and you don't pay it, that's a sign to other potential people that might loan you money that you don't pay your debts on time. So it's a red flag and a sign. So when I pull your credit, the first thing I'm looking at is, have you paid I'm a landlord too. And so when I look at someone that's going to rent from me, I'm looking at, have they paid people on time? And if they missed one payment, okay, I can live with that, or maybe two. But if they've missed a lot of payments to people, it's like they're telling me they're going to pay me. They haven't paid anybody else on time, but they're telling me, but I'll pay you on time. I mean, the reality is, are they really going to do that? Probably not. So that's a big red flag is late payments. That's the easiest one you can do, is just make payments on time. So late payments, how much debt you have. So for example, if I have a credit card and I owe, let's say the limit is $5,000 and I owe $5,000, that's going to kill my credit. I never want to borrow more than about 30% of what the limit is. So in that scenario, I never want to borrow more than about $1,800, maybe $2,000 on that card, even if I'm paying it off every month. Some people say, well, I charge it up and just pay it off every month. They look at that as a running balance and that I'm maxed out every month. So even if you're paying off every month, you never want to borrow more than about 30% of whatever the limit is on the card. New cards, if I'm applying for cards, so if I go to, I'll use Mervyn's because they're out of business, and maybe some of our listeners might remember Mervyn's in the day, but they're out, so I can use them.
Date you.
Yeah, that would date
who
me.
understands.
Yeah. Or Sears. Sears, I guess, is still there.
Yeah.
But you go and they'll say, everyone's had this happen to them, would you like to open an account today? And we'll give you 50% off or $100 off or whatever it is. And that's a killer. Yeah, you say, sure, okay, yeah, great, I'll get this discount. Problem is, any new credit you have extended hurts your credit. Like it's kind of a red flag. Once again, why are these people getting new credit? Do they have trouble? Do they need to float money? Are they getting more credit because they need credit? So it's a little bit of a red flag. Now, if I establish the Mervyn's account and I've had it for a year or two, that's fine. But I don't want to be opening a bunch of cards. I recommend 2, maybe 3 credit cards, and I don't like charge cards are specific to a company. Like Mervyn's is a charge card that I can only use at Mervyn's. I recommend a card that you can use anywhere that pays something back, a dividend of, like I had REI card for years because I liked REI products and they paid me a dividend back. When I started traveling when I was older, I got a card that did Sky Miles, not for a specific airline, but I can use on any airline to reimburse me for Sky Miles. So those perks you can do with credit as well. But those are kind of the two main things, is paying, and then, or I guess 3 things, not making payments on time or not paying at all, like a collection or judgment. Opening new accounts, especially if you do multiple new accounts, and then what you owe versus what the balance is. Those are probably the biggest 3 factors on credit.
Okay, thank you. Can I ask a kind of a technical question, but I think it's relevant, and I'm curious the answer. So when you are borrowing money and you're paying it back, correct me if I'm wrong, there are roughly 2 different categories. One would be an installment loan, and I don't know what the other one is called. Revolving. Okay. Revolving. So the installment loan is, you have a car payment, you have to pay $500 a month for 5 years or whatever the case may be. Then the revolving is, you have a credit card and you can pay, the minimum is $100 a month you have to pay, but you could pay the whole thing off or $200, whatever.
Correct. Yep.
So that's revolving. Yep. So installment, revolving.
Correct.
Are lenders do they like to see one over the other, or like, boy, this person has a car loan and she's been paying that back religiously for 4 years, hasn't missed a payment, she's never late. Revolving, she's got this high balance on that credit card and don't like to see that, but boy, she's diligent paying back that installment loan, or vice versa.
Yeah, so from a mortgage perspective and credit perspective, they do look at so the mortgage is weighted the heaviest because it's a big dollar amount and it's an installment loan. Car payments probably next, or student loans, because they're typically a bigger balance and they're installment loans. So they carry the most weight on a credit report. Kind of back to the secret sauce.
Sorry, which one, the mortgage or the
both? So mortgage number one, probably car loan, student loan number two as installments. They're going to weigh the heaviest on a credit report. And the longer you have an account, the more weight it's going to carry as well. I'll come back to that in just a second. And then revolving is probably the least weighted. So if I'm pulling a credit report and they've got 3 or 4 revolving accounts, like the Mervyn's again, or Visa or MasterCard or whatever, they're going to carry the least weight. Even if so if I've got 4 or 5 credit cards all in great standing, but I was late on my mortgage, that mortgage is going to way offset.
That's a good tip then.
5 revolving accounts are in good standing. And same thing with installments. So installments going to carry more weight than the revolving, but not as much as a mortgage. Now, I want to caveat this a little bit from a
so if you're tight on cash and you have a choice between paying your mortgage or paying down your credit card,
absolutely pay the mortgage.
Pay the mortgage.
Absolutely.
Okay, thank you.
Absolutely. So I'd pay the mortgage first, installment second,
and then revolving.
Yeah, for sure. If I'm going to be late on a
don't
payment,
be late, but at least do the minimum.
Yeah, do the minimum.
Okay.
Do the minimum. And sometimes people will rob Peter to pay Paul in that situation, meaning
borrow from the credit card
to
get the money to pay off
the or they'll open a new credit card account with a higher limit, pay off the old credit card, which is a Band-Aid, but it can save late payments potentially. Yeah. But lenders love revolving accounts from a lending perspective in terms of like a home equity line, for example. That's what credit unions kind of is their bread and butter, because they'll put out this required payment you have to make. It's not because they want to get the money. It's because they don't want you paying more. They'll set a payment amount. So let's say I have a credit card and I owe $5,000 on it, and they say my minimum payment is $75. So I'm like, okay, I'm going to send my $75 in each month.
I'm good.
I'm good. I'm golden. But usually the $75 barely covers interest. Barely. They don't want me. They don't set the payment at $150 or $250 or $300 for a reason, because they don't want me paying extra. They don't want me paying that card off. They want to drag that thing out as long as they possibly can, and have me pay, whatever the amount would be. Years, I'll pay 3 times what I borrowed, or whatever the amount is. So from a lender's perspective, they like those kind of more revolving, because they're going to get way more money over the life of that loan, as opposed to an installment car loan or a mortgage, because they already know kind of this set amount they're going to get on that amortization.
Again, thank you very much for joining. This is Benjamin Driggs, President of Navigate Financial and Financial Advisor. With us today in our office studio is Jim Barnett, a longtime real estate broker and a mortgage broker as well. We appreciate him coming and taking time with us today. And be sure to reach out to us, and we'll send Jim's information separately. But reach out to us if you have any questions. Be happy to help you out and steer you along the way. This is Ben Driggs signing off. Have a good day.